Hey everyone! Welcome back to Financial Futures. Today we have some critical information to discuss about your Social Security retirement, disability, SSDI, survivor, spousal, SSI, and VA checks. There's a staggering 144.5% increase that could affect you, and I have all the details right here. So, let's dive into it. But before we do, can I ask you a huge favor? If you haven't already, please make sure to subscribe to the channel and join us here. Thank you so much. I truly appreciate it. This community is incredible, and I want to continue doing everything I can to support you. Now, let's talk about the 144.5% increase and what it means for your benefits. These shocking numbers directly impact your money, lifestyle, and the fixed income benefits administered by Social Security. This affects over 70 million people across the country, so it's crucial to understand what's going on. Over the past several years, there's been a significant discrepancy impacting your benefits. Let's break it all down. First, let me ask you, over the last 23.5 years, starting from the year 2000 to now, how much do you think your Social Security or fixed income benefit checks have increased due to COLAs? Take a guess. Is it 7%, 12%, or 21%? The answer is a little over 81%. Yes, your benefits have increased by 81% due to COLAs over the last 23 years. At first glance, that seems like a significant increase, right? But there's more to the story. Now, let's look at the other side of the picture. During the same period, how much do you think prices on goods and services have increased? You've guessed it, 144.5%. This is where the major discrepancy comes in. The COLAs are supposed to adjust for inflation and keep up with the cost of living. But as we can see, there's a massive gap between the 81% increase in benefits and the 144.5% increase in prices. This means that over the last 23 years, you've effectively fallen behind by about 63.6%. No wonder seniors and individuals on fixed incomes are struggling more each year. This discrepancy means that while your benefits increased, they didn't keep pace with the rising costs of living. It's a slow but steady grind that has left many people behind. Looking ahead, inflation is still rising, and the projected COLA for 2025 is expected to be in the range of 3.5% to 4.5%. Even with these increases, it won't come close to bridging the gap from the past 2 decades. There's legislation out there to change the COLA calculation from the CPIW to the CPIE, but this alone won't fix the problem. It might help a bit, but the real issue lies in accurately reflecting price increases in the COLAs. We need a better system to ensure that benefits keep up with real inflation. The goal should be to provide a fair adjustment that truly matches the cost of living increases. So, what can we do? Stay informed, advocate for change, and support legislation that aims to address these discrepancies. I will continue to research, keep you updated, and advocate on your behalf. And next, today we're diving into the recent turmoil in the stock market. If you've been keeping an eye on things, you know there's growing fear of a recession, and the volatility has been through the roof, especially after the Federal Reserve meeting on July 31. Let's break down what's happening, why it's happening, and what it means for you. So, let's talk about what happened on Wednesday, July 31. The S&P 500 jumped by 1.58%, its best day since February. At one point, it was up as much as 2.1%. This surge was fueled by the Federal Reserve's announcement that they might start cutting interest rates as early as September. Here's the exact quote: "A reduction in our policy rate could be on the table as soon as the next meeting in September." Jerome Powell said that, and of course, the market loves easy money. But then came Thursday, August 1. The S&P 500 fell by 1.37%, and the Dow Jones dropped 494 points. Why the sudden drop? Well, fears of a recession started to surface, with concerns that the Federal Reserve might be too late in their interest rate cuts. This morning, the stock market took another beating after a worse than expected jobs report, which elevated recession concerns even further. We'll cover the details of the jobs report later, as it's a key trigger for interest rate cuts and will significantly affect the stock markets. But first, let's talk about what happens when the Fed pivots and starts cutting interest rates. When the Fed cuts interest rates, it's common for the stock market to initially go down. This isn't about doom and gloom. If the Fed cuts rates and prints money, also known as quantitative easing, it boosts financial assets in the long run, including the stock market. The concept is simple. Lowering interest rates makes borrowing cheaper, increasing demand. Printing trillions of dollars means more money is chasing the same amount of goods, fueling inflation. Let's break this down with a real-life example. Take mortgage interest rates. Right now, a 30-year fixed rate is close to 7%. If you lower that to, say, 3%, borrowing becomes cheaper, more people buy homes, and home prices go up, causing financial asset inflation. Now, let's talk about money printing, or quantitative easing. Imagine giving every American $1 trillion. Could everyone buy a Lamborghini? No, because you can't print Lamborghinis. More money chasing the same goods leads to price inflation. This is why easier monetary policy boosts stocks and financial assets. However, initially, there's the real possibility that the market will go down in the short run. History has shown this. Now, let's talk about the upcoming Fed meetings. There are 3 left in 2024 in September, November, and December. According to the CME FedWatch tool, there's a 100% chance of an interest rate cut by September. The alarming thing is that more people believe the first cut will be 0.5%. The odds have grown from 5% to 22% recently. Personally, I think it will be a 0.25% cut, or 25 basis points. The market also expects cuts in November and December. The last projection in June suggested 1 rate cut this year. In March, the projection was for 3 cuts. So, it's uncertain how many cuts we'll see, but the market is volatile because it's questioning whether we'll get a soft landing or a hard landing. The GDP numbers recently came in at 2.8%, far from recession territory, if you believe those numbers. However, unemployment is rising, and the July jobs report showed a sharp slowdown in hiring, with only 114,000 jobs added and the unemployment rate increasing to 4.3%. The government is partly blaming the weather for the slowdown, citing Hurricane Barry. Regardless, this increased volatility is driven by recession fears and a weakening labor market, with concerns that the Fed has been too slow to respond. Look at the bond market. The 10-year yield has dropped below 4%, with rates plunging to 3.82% this morning. This fast movement is wild and shows the market's uncertainty. That's the situation and the explanation of what's going on. Let me know what you think. Has the Fed been too slow to cut rates? Should they hold rates longer or even increase them? Share your thoughts in the comments. Thanks for watching. Don't forget to subscribe, share this video, and check out our other content. Have a great day and take care.